Good morning, everyone, and again, welcome to this press briefing, press conference, post-MPC meeting. Today, November 26, 2019. But before beginning, I would want to express our heartfelt condolences for the damage, fatalities, and more generally the tragedy that has taken place in West Pokot over the last few days. And also for yourselves, I extend my condolences to you, because a member of your profession was cut down last Wednesday in Somalia. And obviously we offer our deepest condolences to you as well. So let's get to the substance of the meeting. I'll again go through the specific questions and or specific issues that came up in the context of the discussion yesterday by the MPC, that's the Monetary Policy Committee, and eventually the decision which you already know. So the first thing, the first item here is on inflation. As always, we begin with this because our mandate is first and foremost focused on price stability, price and financial stability. And inflation remains stable within the range, the target range. And in October, the CPI inflation was up at 4.9%. Which compares to 3.8 in September, but this still remains around the midpoint, the mid of the range. So this obviously is not a concern. And this was despite significant increases in some food prices, tomatoes, maize and maize flour, peas and things like that. Because of things that are specific to those commodities. Non-food, non-fuel, inflation remains stable. It is actually below 3%. It was at 2.6%. And fuel inflation also remains low and stable, in line with the trends in the domestic and international energy markets or energy prices. And this is despite upward revision in some pump prices this November 14th. And so we expect that despite that, we expect inflation and fuel inflation to remain modest. We can talk a lot more about inflation, but I think this is a well-rehearsed sort of territory, so I'll move on to the other things. The second element I wanted to bring to your attention is the situation in the global economic outlook. And this also you're familiar because we've had some conversations with you in other places. But suffices to say that the global economic outlook is really dire. Global economy is expected to grow by 3% in 2019, and then 3.4% in 2020, next year. And this follows continued downward revisions. These are IMF numbers, and they have been revising them. These last numbers were revised in October. And as I have said before, the rule of thumb was, and for me still remains, 3% is the stalling speed for the global economy. So, and already you can see that the central banks in advanced economies have taken pause. They've paused the monetary withdrawal that was there and actually revised direction of their policy and actually are adding stimulus in the economy. So in their economies, you've seen the outcomes of their MPCs over the last few months, at least since October. That has been quite clear. Global economy has more hidden bad news in that we have what we call a synchronized downturn So all the economies are going down at the same time. It used to be that one could argue over decoupling, where you have said the emerging markets are going in a particular direction and are therefore, let's say, stabilizing the rest of the global economy. Or for that matter, you have the US economy dragging the others away from recession. Now everybody seems to be going down at the same time. So this is quite worrisome. Now, the US economy is expected to grow at about 2.4%, which is quite low. China, 6.1%. But next year, China is expected to grow at 5.8%. It's the first time China is growing below 6. So if this doesn't sound alarm bells, I don't know what will. We can talk about other things, but I think the uncertainties are, there are a lot of uncertainties, and we also don't know what trigger there will be for a downturn, a significant downturn. So not an interesting scenario, hence the assessment that the outlook is quite dire. So let's move back then to Kenya, but we'll move back to Kenya in the context of the external sector. And here again, I'll be quite quick. The external position continues to improve, and the current account deficit for the 12 months to September was at 4.1% of GDP. 4.1% of GDP compared to 5.1 in September of 2018. Now we project the current account for 2019, the year, to come out at 4.3%. This is a deficit, 4.3% of GDP. And if you recall, some time ago we talked about we were expecting it to be around 4.5% of GDP. And actually, we had always said that in the medium term, 5% is of a deficit of 5% of GDP is more or less where we expect it to be. But anyway, we expect this to be at 4.3, and it reflects a narrowing of the trade balance. And you read into this the lowering of imports related to SGR, related to food. And also some key exports have been falling, unfortunately. We need to flag this: tea, horticultures, and coffee. Those export numbers have not been strengthening, and there are issues that are specific to each of those sectors that need to be addressed. But also there has been some positive exports, or rather improvements, positive numbers, growth in exports, such as manufactured exports and indeed chemicals. So on the whole, the trade balance has narrowed, and it is a mixture of all those things I mentioned. Of course, services exports remain resilient. Transport, telecom, finances, and remittances remain strong. This we've been talking about. Actually, for the months through, I think we had October, there are only 2 months that had lower monthly remittances compared to the same month last year. So now the growth rate is not as it was last year. Last year it grew by something like 30% or some astronomical number like that. But I think the point is that the remittances have remained resilient, and I think we understand why that is the case. On the whole, also FDI has been quite satisfactory compared to the past. But I think what I would mention here is that in terms of financing of the current account deficit, there isn't any concern. Fully financed by FDI, fully financed by other capital flows that are coming in, including, of course, portfolio investments that has been coming in. That means the foreign exchange market will remain balanced, and there should be no concerns in those markets, in that market going forward. So then moving on, banking sector. The banking sector remains sound and resilient. I'll just mention a few things about that. Again, this is well rehearsed. So first, liquidity remains high. Overall liquidity is something in the order of 51% in October. And it is across all peer groups, meaning there is liquidity across all peer groups. An interesting development here is that there has been larger, or should we say greater flows of deposits to the medium-sized banks. That was quite striking. And it is interesting because what this means is that the customers are responding to, let's say, services that are aligned to their needs. So if banks provide services or products that are aligned and whatever those customer relations, clearly the customers will respond accordingly. And this is what has happened. So it's an interesting thing in terms of if you ask the question whether bankers can actually learn a new thing, a new trick. And will customers also learn new tricks? Maybe these are not new tricks. Maybe these tricks have been with us, since Cain and Abel. But anyway, we leave that, or at least since banking was invented. So then, credit risk remains elevated, but this is easing. As was mentioned in the press release, NPLs to gross loans, the ratio, that has come down in October, marginally, to 12.3% from 12.6% in August. And yes, the areas that there were where decreases were noted was also flagged in the press release. I'm not going to repeat that. But suffices to say this has come on the back of repayments and also recoveries that banks are doing. If you recall, some time ago, we've been pushing this thing, banks have been pushing this interaction relationship with their borrowers, those that have NPLs, to try and let's accelerate or work with them and recover what needs to be recovered. There's no one-size-fits-all solution. It has to be done customer to customer, bank to customer. So it is hard work, but that's why they're bankers. That's why they wake up in the morning to deal with customers and where the customers are in that way. Operational risk in banks obviously remains, and therefore banks will need to remain alert. I think this is something that we all understand, and I think there isn't much to say there. There's nothing new except just saying that banks and everyone, including yourselves, need to remain alert. We could also say that there has been specific, let's say, campaigns, and there's one that I want to flag, which is a campaign to, let's say, educate or to remind customers about about security concerns, so that they can do what they need to do to minimize, to reduce their own risk in terms of not falling prey of all those marauding, let's say, crooks that are out there who want to steal your PIN, who want to trick you with some get-rich-quick scheme. Unfortunately, we've seen, and you have, I'm sure, been perhaps the first ones to see the very sad stories that some people have fallen into these sort of schemes or these traps. Finally, in terms of banking, the transformation of the sector continues. And I think here first we have the consolidation that we talked about before. Consolidation of the banks continue. And again, the reason for the consolidation, as we have said, is so that they can become more resilient. That's the objective. And have a much more resilient and stable business plan, or let's say business program, for the future, not just for the past. Not the past. Something may have worked very well in the past, but they definitely need to refresh and have something that is aligned to the shocks that will come in the future and so forth. And here I think, just to remind you of the most recent ones, NIC and CBA, those happened just after our last meeting. And then we also have the KCB and NBK. That actually is quite interesting because it has been more than 30 years in coming. More than 30 years. I mean, there are people that were not born when the crisis started and the entire renovation, or should we say, restructuring of NBK started. They are probably now working as employees in those banks. I mean, now you can imagine the damage it has caused to people and all those other things. It is important to appreciate that delaying these things causes a lot of damage. But anyway, that has happened, and I think it is important to flag it as a successful consolidation. A second element in the transformation in the sector relates to the repeal of interest rate caps that happened November 7th. And here, I think there is a lot of maybe uncertainty, a lot of uncertainties from the perspective of the population. And I would want to remind and indeed emphasize to the population that this time will be different in terms of the way the banks will react. And we have explained that they are not going back to the same old ways of the past, the Wild West kind of banditry. No, they need to be responsible, and we have explained to them exactly how they need to be responsible. And it is our business to communicate this to the population, and so that they can realize that actually they should be number one with regard to banks, because banks should be becoming more customer centric. That's the one thing, that actually they will be pricing their loans appropriately, meaning in line with my risk, right? And they have to assess my risk, not randomly, but in a sort of a structured way, so that they can say, I am more risky than the person next to me by this amount, and so forth. And also other things related to transparency, that they will tell me what is let's say, what are they offering others, and what are they offering me. And gone are the times when they say, it's this, take it or leave it. And if you don't come back in 6 hours, this deal is off the table. That's sort of been, let's say, rushed into a decision, does not speak to customer centricity. And then obviously the last point, that they need to be more ethical, meaning ethical practices. And meaning they should be they should stay away from short-term gains. The focus on short-termism, this quarter returns, what is my bonus, and things like that. Optimism remains high, the level of optimism. Non-banks, their level of optimism is around 74% of respondents were optimistic or very optimistic about economic growth prospects. And that is actually lower than where it was in September. In September, it was 86%. But 75% is still a good number, 3/4. Banks also remains very optimistic, with 92% of respondent banks being optimistic or very optimistic. So I think the point here is all these are good numbers. Good numbers. I don't want to talk about forward bookings, but I think we'll be releasing this the results of the market survey soon, so you can look at it. But I think the numbers, they are good in terms of forward bookings in hotels and things like that. I want to talk a bit more now about the outlook on output. We received the data from quarter 2. And therefore, we have completed, or we now have data for the first half of 2019. And the first half of 2019 grew, or rather GDP grew in the first half of 2019 by 5.6%. And really, for this compares to 6.4% in, well, actually, 6.4% in the second quarter of 2018. I think I have given too many numbers now, and so let me just leave those there for now, okay? What I wanted to underscore is the following. So using the data that we have already in Q1, so the actual data Q1 and Q2, so the first half. And then we looked at the leading indicators these are the indicators of economic performance so far. So these are things like looking at imports of intermediate goods, and this show positive, or rather it correlates well, or it suggests that there's dynamism in the manufacturing sector. Manufactured exports are rising. The PMI index also shows signals that there's positive activity in Q3. Other things, electricity and water, etc., etc. On the basis of that, of all this, we have re-estimated GDP growth for obviously Q3 and Q4, meaning for 2019. And we've re-estimated this, actually it has come out at 5.9% in 2019, for 2019. This is really not different from 6% that we had a little while ago. We've been talking about 6% for some time. So 5.9 is really not different. Materially, I assume that's the word you'd use, but we economists don't use materially. It's financial people that use that. So it's 5.9, which obviously is robust growth compared to, let's say, what's going on. And this is why I wanted to first flag what's going on in the global economy and so forth, and the numbers that are there. But be that as it may, this is not the end of this. We also did a much more robust check on the so-called output gap. There's a curious line in the press release, which, just for interest, I'll go back to it. It says, the MPC noted that inflation expectations remained well anchored within the target range and assessed that the economy was operating below its potential level. Okay, so I want to explain what that is about. So basically what we did is to get a good check on what we call the output gap. So what we did is, given current investments and, let's say, potential of production, excess capacity in plants, things like that, you ask yourself, how much output can the economy generate if all that excess capacity is used, right? What can the economy generate? And that defines potential output. So it's a thought experiment. So that is potential output. Now, it's not just a thought experiment. You actually run some econometric estimations, and I'm glad to see some econometricians on our, in our MPC. The point is that is done technically, and you can actually come up with that estimate, and our team did this and in a rather robust way. Secondly, you then ask yourself, how far are you from this sort of potential output? So for economists, you could think of yourself of this as the sort of the production frontier. And so you're asking yourself, how far are you from that sort of production frontier? But the point here is that how far are you? And basically, you calculate how much you're producing now and relate it to the potential, what you could be producing, as I mentioned before. Now, doing all that, we have calculated that the difference is what we call the output gap. So potential output would generally, in this case, be higher than where we are, all right? So we can produce even more because there's slack in the economy. And with this is what we then say that the output gap has been negative or is negative. We calculated it as negative, meaning there's that gap, you understand? Now, it may be confusing, but it is, even though it's confusing, I'll state it. At times, potential, or rather, your output is higher than your potential. You ask yourself, how is that possible? It just means that you are running in an unsustainable way. So the way you can run, let's say, the marathon, but you then move much faster, but you know you can only sustain it for a few hundred meters. But you cannot continue running the marathon at that pace. I hope we understand what I'm saying here. That at times that happens. This is not the case for us today. What is the case today is that we have a negative output gap, and we estimated this of something like 0.9% of our potential output. Okay, and this was in 2019. This year. Okay, so we can actually improve our production, our output, by a little more than 1%. Okay. Now, we then tested this thing to figure out how robust it is. And we tested it in various ways by just looking at non-agriculture. You know, after all, agriculture very much may be running on the whim of some rain, right, or any of these things. So we tested that, and in the end, this is how we realized that, or the team realized that this was actually a robust estimate. You may ask yourself, why is it that in the past we were saying that it's about, the economy is about potential, is around the potential? And the answer is twofold. One is the robustness of the estimate. That's really the issue. It is important that we make decisions based on data, what the data, the evolving data is, not on sort of hunches and political imperatives or whatever other things that one may want to make those decisions. That's why central bankers are who they are. So I think that's important. I could also talk a bit more about some technical aspects of this output gap, but in the interest of let's say, time and other things, I'll just leave it there. Just to emphasize that there was actually an output gap, which showed that the economy can actually grow faster. Remember last time we had even been saying that it could grow even as much as 6.5%. Frankly, we are at 5.9, so that's around 6. And I told you that we are around 1% more or less output gap. So we can actually grow to around 7% without much problem on inflation. So when we talk about demand pressures are muted, that's what we are saying. We are actually saying that demand can increase without creating some sort of demand push inflation, or price push inflation. I don't know which way. Anyway, whatever. I think you understand. So that is really the point I wanted to make in terms of why is it that this was important. Now, noting the output gap, and also noting that the fiscal policy was actually less accommodative. It was actually it was going to. I mean, they were consolidating. So you remember we talked about the consolidation of fiscal policy, And their consolidation, if you look at the primary balance, it will be something in the order of 1.8% of GDP. So it is actually a substantial consolidation. So those two were more than sufficient reason for the MPC to go ahead and really adopt and execute what would be an accommodative monetary policy stance. So switching to that. That's really the point here. Now, it's true, the issue that has been on the table for some time is it's all fine for the Monetary Policy Committee to want to adopt an accommodative monetary policy stance. And in the past, we made the point that there was a problem in that we weren't sure whether there would be sort of a perverse reaction, and therefore what would generally be accommodative ended up being a tightening. Now, the advantage here is that the interest, and this was because of the interest rate caps. So the advantage now is that the interest rate caps are gone. So we know exactly the direction of accommodative monetary policy. And that's what we did. Now, having said that, the question is, obviously, we have not been using this sort of monetary policy approach for some time because of the interest rate caps. So will the economy remember how this works? And the answer is there has to be some relearning. Relearning of banks, relearning of consumers, so that actually we can have the correct reactions. So that is expected, and indeed, even from our perspective in the central bank, there will be some relearning. We need to recalibrate our models so that we can tell you an impulse of X amount will probably lead to an X amount or X percentage of GDP over a period of 6 months or over a period of 2 months. Those sort of rules of thumbs have now been, let's say, messed up. And we need to go back to a territory where we now understand. But this is why we come to office every day. This is our business. So we now feel, in a sense, unshackled. The economy was running with, if you want to, an analogy about motor cars. So we were driving this economy with a handbrake on. And at the same time, there was somebody who was really pushing on the accelerator, i.e., the National Treasury. And so we were trying to manage all this thing, mainly on the brakes, right? I know, you're looking at my feet, that's not proper. It's the brake on this one, not this one. But now there has been some sort of rebalancing, meaning the person who, from the fiscal side, there will be more, they'll consolidate, less accommodative, and we therefore can rebalance, be more accommodative. The handbrake has been pulled out, or rather has now been disengaged. And so the car now is in a much better situation. You can bring it to better balance. I want to say 3 things, and then I'll open the thing to questions. The first one is easy because it was again about interest rate caps. Just to remind you that this is an area where we have made our views quite well known about what we expect banks to do. I've now re-explained it in a nutshell. They are also, we will be publishing an op-ed in the various newspapers, and also yourselves will be open to other ways of communicating with you on this matter and other matters. The other one which I wanted to put on the table is you recently had, there was a circular that was issued by the government sure where to put it now. It's okay, it's here somewhere. Okay, I guess it's downstairs, but that's okay. We'll figure it out. If not, then I'll ask for it. So there was, it's okay. There was a government circular that was issued earlier this month requesting all state corporations to surrender their funds to the National Treasury. I think you know the circular that I'm talking about. Um, and uh, and the question there, I think there are two questions which I want to answer. Um, and the first one is, and to be very precise, they were requested to take whatever, if they had any, no, it's okay, it's not the circular, it's something else. They were requested to have, no, it's okay, yeah, yeah. They were requested to, let's say, uh, surrender their holdings of treasury bills, investments in treasury bills, all deposits to the National Treasury. So, from our perspective, the first question is what's the impact on monetary policy on this? And I think I want to say that the discussion that you have been having has overblown this situation. Basically, the state corporations have holdings of about 5% of securities, T-bills and government securities. Those are the numbers that I forgot. They're on my desk, but that's the extent of it. So they're around 5%, actually at 5%. In October, it was 5%. So you can see it's not a large holding, right? Liquidating 5%, even if you did it in one shot, wouldn't shock the system, if you see what I mean. Secondly, obviously one should appreciate that even if it was 5% and there were concerns about impact on monetary policy, or for that matter, impact on the treasury bill market. Obviously, we wouldn't sit idle. We would actually work with National Treasury. We would coordinate and sort of say, hey, maybe we should do it this way or some other way. That way you'll maintain stability in the market. So I just wanted to at least allay your fears, some of which have been written up in various places, that it cannot be that a decision like that happens and then there's chaos in the treasury bill market or government securities market. No, it is actually something that is not as. Remember pension funds. Pension funds have something like what? Is it 31%? Around 30%. So state corporations are small. That's one thing we need to accept. So just like like Kenya Oil or any of the other parastatals, we are just thrown into this ring and we are forced. And that couldn't be farther from the truth or from the way things work. No, we don't quite operate under those sort of regimes. Our regime is very clear. The regime that we work, there is a lot of independence and also in terms of relationship with other executives and things. And in particular, the only reason for us to hold T-bills is to do monetary policy. So, so to tell us one thing or the other doesn't make sense. What's even more is anyway, I don't want to go into all the rubrics, but I want to make a separate point for you. Bailouts by central banks have never worked. So if the government is short on, it wants to, like now they are short on revenues and they want to, in a sense, assort the central bank and grab whatever resources they are, right? That has never worked and it will never work. Such bailouts monetize the deficit one-to-one. And as you know, which means that the central bank prints money. It will be printing money to cover the deficit, whatever it is. And also it will draw the central bank as a conspirator in fiscal decisions, right? Whatever they are. And this, of course, will subordinate the central bank's key responsibilities to the fiscal decisions and political imperatives that are running, let's say, those fiscal decisions that have been made out there. Whatever they, or however good they are, building roads, purchasing things for schools and all those are good, but that is not what should subordinate, that's not what should trump the responsibility of the central bank. So we have a term for it, of course, as economists, we call it fiscal dominance, which obviously is a euphemism for violent assault on the central bank. I mean, you should see it that way, right? So I think that is something you should be clear about. And you should be afraid, very afraid, of what I would call, wolf in sheep's clothing. Those that, think that they can have something from the central bank and at the same time recover. Now, we are very fortunate though, because there are sober minds at the Treasury that understand all this and will not do this. They won't do this. But that does not stop the fringe from talking about it. So maybe the talk by some elements in other places have gone beyond the realms of this sort of sober mind discussions. Now, the central bank itself should always remain ready, poised to deal swiftly with any shocks that may come, and relating to its mandate. And it should be free to choose the most appropriate instruments to deliver its mandate. And this is what we call central bank independence, right? This is why it is essential to have the central bank in a strong financial position. Otherwise, the central bank would be consigned to the uncertainties of crisis after crisis, right? So, I mean, as I said in the press release that we sent out, we did make the point that we had actually increased our paid up capital from 20 to 45, 35, 20 to 35, which was essential. And we have explained that in various ways. Otherwise, you have this crisis after crisis short-sightedness, and of course the excesses of party after party swag. I rest my case. What else?